Welcome to the Deep Dive. Today we're looking at something pretty interesting, a major player in India's defense sector making some significant moves. We're jumping into the latest unaudited results for Zen Technologies Limited, Zen Tech. Specifically, their Q2 and half-year numbers for fiscal year 2026, ending September 30th, 2025.
Yeah, and Zentech is really at a fascinating point, right? Caught between India's big defense modernization push and, well, the future of warfare itself.
Absolutely. Our mission today is, well, to cut through some of the noise. We need to look past the headline figures, understand this external factor, kind of geopolitical headwind, you could say, that affected their recent sales, and maybe most importantly, map out the strategic acquisitions they've made. These buys seem set to really redefine the company's tech capabilities moving forward.
Okay, so it sounds like there's a narrative here, maybe some short-term challenges paving the way for potentially much bigger long-term gains. So how does management actually explain the lower turnover compared to last year? Well, the chairman and MD, Mr. Ashok Atluri, addressed it directly. He acknowledged the lower turnover for Q2 FY26 versus Q2 FY25. But, and this is key, he stressed that the company's underlying operational strength is still there. He used the phrase, continued operational strength and disciplined execution.
Okay, disciplined execution. But how do we know this isn't just, standard management talk? Why should we believe it's just a procedural delay and not something more worrying, like losing competitiveness?
That's a fair question. They linked it very specifically to the aftermath of Operation Sindor. Now, this wasn't just some minor event. It was a significant security situation, and it actually validated the need for certain defense technologies very immediately.
Right. So Operation Sindor triggered a kind of emergency response from the government.
Exactly. After the operation, the government kicked off emergency procurement measures, to plug immediate operational gaps. And when the government shifts focus like that, putting all resources into urgent mission-critical buying, well, it naturally slows down the normal process for regular requests for proposals, RFPs.
Right, so the standard longer-term contracts sort of get put on pause while they deal with the immediate fire.
That's a good way to put it. Management is clear that these deferred orders are still active, they haven't disappeared. And here's the other side of that coin. Operation Sindor, while causing delays, also acted as a powerful real-world test for Zen's equipment. It led to a definite uptick in interest, especially for their anti-drone systems. It proved the tech works when it really matters.
Okay, so that's a fascinating trade-off. A temporary administrative slowdown, yes, but also incredibly valuable product validation and potentially increased future demand.
Interesting. Before we dig into the actual financials, what about Zen's subsidiaries? You mentioned Applied Research International, ARAPL, and Unistring Tech Solutions, UTS. Are they helping cushion this blow at all?
Yeah, they seem to be contributing positively. Their contributions are growing, which suggests that Zen's earlier investments in integrating these subsidiaries are starting to provide some stability. It helps, when the core business faces these kind of temporary bumps in the road. Okay, good. Let's get into the core numbers then. We need to see how robust this operational strength really is when sales are down. Let's focus on that Q2 consolidated comparison year over year. Looking at the top line, yeah, you can definitely see the impact of those delays. Consolidated revenue for Q2 FY26, it dropped from over 250 crore last year to just under 200 crore this year. That's roughly a 20% dip.
It is. But here's what's really striking. Despite the 20% fall in revenue, their profit after tax, this is adjusted for non-controlling interest, or NCI, only decreased slightly. We're talking about 5%. The PAT held up remarkably well, coming in at 59.4 crore compared to about 62.67 crore last year.
Wait, hang on. Lose 20% of revenue but keep 95% of your profit? How does that even work? That really points toward efficiency. Strong margins.
It absolutely does. It shows that disciplined execution isn't just talk. You see it directly in the margins. The operational EBITDA margin didn't just hold steady, it actually improved, quite significantly in fact. It climbed to 37.76% in Q2 FY26. That's up from 33.21% in the same quarter last year. That's a substantial improvement in their profitability profile, even with less revenue coming in. Their cost management must be incredibly tight.
Wow. That 37.76% margin, that feels like the key number. It strongly suggests the issue really isn't operational performance. It's more about the timing of those government orders.
Exactly. And if you look at the half-year picture, H1 FY26 versus H1 FY25, you see a similar story, just scaled up. Total revenue down about 25%, PAT down around 23%. It confirms that this delay wasn't just a one-quarter blip. It stretched across the first half of the fiscal year.
Okay, understood. Now, before we move on to strategy, I noticed a small note in the consolidated P&L about an exceptional item. What was that about? Anything significant?
Ah, yes. That was more of a technical accounting thing related to a company called AI Technologies Private Limited. Zen's stake dipped just below 50% because of an external funding round in that company, so they technically lost control. This meant they had to deconsolidate it and recognized a small exceptional gain, about 94 lakhs. AI Turing is now just treated as an associate company, not really a major factor in their core operations or strategy.
Got it. Just a bookkeeping adjustment, essentially.
Okay.
Okay, let's pivot to that core strategy then. Because it seems like Zentech is using this period, this administrative slowdown, to really aggressively reshape itself. They seem to be pushing hard to diversify and get away from that lumpiness you often see with big, irregular defense contracts.
That's precisely the plan. They're actively transitioning, moving from being primarily known for defense training systems towards becoming a more integrated, broader defense technology provider. And they've got the resources to back this shift. Their liquidity position is very strong, over 1,100 crore in cash and equivalents as of September 30th, 2025. That's a significant war chest.
And they're deploying that cash both externally, through acquisitions, and internally, right? Still investing in their own R&D.
Yes, both. The acquisitions are definitely the headline grabbers, the fast track. But they haven't abandoned organic growth. They spent nearly 14 crore, 13.87 crore to be exact, on R&D just in the first half of this fiscal year. But you're right, it's those four big acquisitions that really paint the picture of their future direction. They span across land, air, and sea defense domains.
Okay, let's break those down. How are they building out this new portfolio? Let's start at the maritime side. You mentioned something about recurring revenue.
Right. That was the Applied Research International Private Limited ARIPL acquisition. This brings Zen directly into the naval and maritime simulation space that expands their market. But perhaps more importantly, from a financial perspective, ARPL brings in digital software as a service, SaaS, and annual maintenance contract, AMC, revenue streams. That's recurring revenue, much more predictable. Plus, they got over 120 proprietary IP assets in the deal.
Okay, recurring revenue, that's key. Then they moved into the air domain, tackling a critical component for drones.
Yes, with Vector Technics Private Limited, this was a major step into the drone ecosystem itself, specifically focusing on high-spec motors. We're talking aerospace-grade, customizable motors for UAVs. This is huge for India's self-reliance goals, the Atmanirbhar Bharat initiative, because propulsion systems are often imported. This acquisition helps reduce that dependency for building drones domestically.
Makes sense. And then on land, robotics seems to be the focus there.
That came through Bhairav Robotics Private Limited. This acquisition basically fast-tracked their entry into defense robotics. Instead of spending years developing things from scratch, they acquired a company that already had fully developed prototypes. This gives them an immediate expansion in their land combat offerings.
And finally, they added an offensive capability to complement their existing anti-drone tech.
Correct. The fourth piece was TISA Aerospace Private Limited. TISA brings loitering munitions, sometimes called suicide drones, into Zen's portfolio. This is a natural fit, the offensive counterpart to their existing counter-UAS, CUAS technology. By acquiring TISA, they essentially bought R&D progress, cutting their time to market for this critical capability by maybe 18 to 24 months.
Wow, okay. That's a rapid build-out of capabilities across the board. Very ambitious. Now, let's bring this back to the present. What does the actual order book look like right now, considering those procedural delays?
Well, despite the slowdown in new order finalization, the consolidated order book is still quite healthy. As of September 30th, 2025, it stood at 675.04 crore. Now, in Q2 itself, they executed 173.57 crore worth of orders, which again shows they can deliver. But they only booked 94.05 crore in new orders during that quarter. That difference confirms that the bottleneck was indeed in getting new contracts finalized, likely due to that post-Operation Sindor administrative focus we discussed.
And is that order book mostly domestic, or are they seeing export traction?
It's heavily weighted towards domestic orders right now, about 554 crore domestic versus roughly 121 crore in exports. And that heavy domestic reliance probably underscores why scaling up is such a key priority for them.
Right, let's talk about that scaling plan. How exactly are they planning to make their revenue less lumpy and more predictable?
They seem to have two main tracks running in parallel. First, obviously, keep pushing equipment sales, especially in those high-growth areas like anti-drone systems, maybe space drones, and advanced simulators. But second, and this seems really critical for their long-term financial health, they need to aggressively scale up the AMC, the annual maintenance contract side of the business.
Why is that AMC piece so crucial for stability?
Well, think of it like this. The goal is for the steady, predictable, recurring revenue from those AMCs to eventually cover all their fixed operating costs, salaries, rent, utilities, the basic cost of keeping the lights on. If they can achieve that, where recurring revenue covers fixed costs, then every big equipment sale, which typically has high margins, essentially drops straight profit to the bottom line. It makes their overall financial performance much less volatile and far more predictable.
Okay, that makes perfect sense. And looking at their current Q2 revenue mix, you can see exactly why scaling AMC is such a challenge and a priority. Equipment sales were huge, almost 115 crore,
Yeah.
but the AMC segment, only 9.76 crore. That's a massive gap between the two right now. They've got a long way to go to get that AMC revenue covering fixed costs.
That gap is the challenge. It's the immediate operational reality they face, and they know it. They've explicitly stated they'll continue looking for more inorganic acquisitions, probably ones that strengthen those annuity streams, and they'll keep investing in R&D for these complex new systems, which likely come with bigger AMC potential down the line. The whole strategy points towards this transformation into a much broader, integrated defense tech company.
Yeah, that really wraps up the story nicely. It's this dual narrative, isn't it? On one hand, you have these temporary operational headwinds, the procedural delays linked to Operation Sindor. But on the other hand, you see incredibly strong underlying financial health, shown by those impressive margins, and this really fast-paced strategic acquisition spree aimed squarely at the future.
I think that's the perfect summary. The big picture is that Zen has made a very deliberate strategic shift. They're moving beyond just training and simulation. They've rapidly bolted on sophisticated next-gen capabilities, counter-UAS, drone propulsion systems, loitering munitions, defense robotics. They're positioning themselves not just for India's self-reliance goals, but as a serious player in modern defense technology globally.
Okay, so here's something to think about, a final thought perhaps. We know Zentech's anti-drone tech got validated in a real-world scenario with Operation Sindor, and they've just spent heavily to acquire and integrate CUAS, loitering munitions, robotics, this whole next-gen portfolio. How quickly do you think this newly integrated, battle-tested, and parts offering will start showing up as a much bigger slice of the export pie within their, say, 675 crore order book over the next few quarters? Will international buyers bite?
That's the multi-million-dollar question, isn't it? Whether the global market sees this combined capability set from Zentech as a truly compelling, proven, and export-ready solution now, we'll definitely be watching that geographical split in the order book very closely going forward.
Definitely something to keep an eye on. Until next time.